Big businesses look to us for specialist insurance solutions. Do you? 85 of the top 100 JSC listed companies trust us to protect their businesses. Celebrating 100 years of insurance. Good and proper then, now and always.
With the slide in the economy, credit insurance has come to the fore as companies strive to fend off bad debts. My guests will discuss the ins and outs of this type of insurance cover. They are Peter Dingemans, National Practice Leader, Trade Credit at Marsh; Steve Smith, Head of Credit Insurance at Santam Structured Insurance; and Janssen Harper, Managing Director at Credit Innovations. Welcome, chaps. Interesting topic. Have you seen a rise in the number of businesses coming to you for credit insurance because of the state of the economy, Steve?
Yes, I think there is a new interest in the product, obviously because of the difficulties that companies are having out there. But I'm not sure that it's triggered just by the economy. I think, insurance products as a whole are sold all the time, and different channels come into play. I mean, Peter is obviously from the broking fraternity. Their job really is to go out there and to identify opportunities, to pique the interest of clients, to make sure that they understand why is it necessary, and to get them to come to speak to us as insurers to say, please, can you take our risk for us?
Okay, so insurance is always sold.
Sold.
So, Peter, have you seen a rise in the number given the state of the economy?
No, definitely. I think with the current economy, more businesses are failing, are going into bankruptcy or business rescue, or can't pay anymore, and our clients feel it, and they're looking for solutions in order to do something about that risk of non-payment. So we see it, but on the other hand, there's an uptick. Companies, because it's a difficult economy, also looking at cost.
Absolutely.
So they are interested, but it would also mean if they don't have insurance right now, they want to take the insurance, it's additional cost, which is also a difficult choice.
Good point.
Yeah, I think some of the big corporate failures, if I can call it something like Steinhoff, have sparked new ways that companies are looking at their risk management. In the past, big listed companies have kind of not been insured by suppliers, and I think we definitely see that they are looking at the risk management to insure them for the shocks that they can't plan for.
So it's probably a standard risk mitigation practice for larger companies, but I wonder when smaller companies, is this not traditionally what they would look at because of the cost, I guess?
It's a balance. It's not something that takes away your credit management. If you can build it into or you should be able to build it into your business model, it's a cost that forms part of the business cycle, because insurance is like anything, credit insurance, traditional other insurance, it's there to protect you for the events that you can't plan for. It's not, if you've got a business that that will lose 3 million a year as an example, you build that into your cost, but you want to protect yourself for the 30 million risk that you can't plan for.
If I add to this, I think it's definitely also a product for smaller companies. We see a lot of small companies having or making use of this product. Why? Because they often don't have a very strong balance sheet, so they really need the protection. While other large corporations, they have strong balance sheets. They can deal with a loss or a big claim easier than smaller companies. So we see the use of credit insurance basically in all layers of the...
Yeah, but are the smaller businesses more reluctant because of the cost factor, Peter?
Definitely, of course. Everybody looks at cost. So they will definitely think twice before taking it on. But I think most, especially smaller companies, if they've run once in a bad debt, then then they know what the potential effect is. They have been working a whole year basically for nothing, and hence they want to have this product, so they see the added value.
So let's go on to the mechanics of what credit insurance actually is, Steve. So we can deal with it separately, and domestic, and then move on to foreign a bit later. But let's start with domestic debtors. So as a business, I come to you and say, this is my book, or do I say an individual debtor? How does it work actually?
It can be either of those. We get approaches for people who want to look at the whole book and some people who just want to look at individual debtors. Obviously, from a risk point of view, as the insurer, we try to avoid anti-selection. We're not really interested in people coming to us just with the worst risks. Our view is that the client is always responsible for their own risk management, so they should be taking care of who they're doing business with on credit terms anyway, and they should be the first layer of defence. We should be part of their risk mitigation, of transferring the risk that they can't afford to take for themselves. But in terms of what is normally covered...
Just go back to, so isn't that the point of insurance, that I only want to cover the risk areas? I'm not interested in covering the guys that I know are going to pay me back.
It's the traditional objection for credit insurance, but it's also the benefit of credit insurance, that the insurers do the risk assessment. And obviously they are not insuring burning houses. So they insure companies or buyers that are currently, that are good risk. Yeah. But risk can turn very quickly.
Okay, so like most insurance policies, Steve, that's just the way it works.
Exactly. I mean, you don't want to be writing a guaranteed loss. I mean, that's not really for the benefit of anyone, because then that leads to reckless trading and so on. It's not good business practice. But in terms of what's covered, which I think is what you were alluding to as well, is trade credit insurance traditionally covers business-to-business transactions, which are done on credit terms. And it is just for trade things. So we're not insuring as trade credit insurers long-term projects, that sort of thing. It is normal trade
with sales, basically.
Yeah.
It wouldn't be any other assets.
Yeah.
And you're covering them for what? Total
payment default.
Bad debt? Yeah.
It's payment default, business rescue, liquidation. Those are the normal coverages that are given.
What about late payment, which would still affect the business, and that's one of the advantages of why they would take this out as cash flow?
That's part of the payment default.
So even though it's 90 days, would they get some benefit for that?
Yeah, normally, I mean, you would look at the trading terms, and then if someone doesn't meet the trading terms, we would be advised of it. The normal thing for us then is to go into a mitigation type of scenario where we're going to try and get the debtor to pay. Yeah. But obviously if we're unsuccessful and then there's another time frame after the initial period, then the claim would become due and payable. But it wouldn't stop there. The client would get paid in terms of his policy, but we would then continue to try and mitigate the loss to get salvage from there.
How expensive is this? You mentioned cost, Peter, so how much would this cost?
No, that depends obviously what the risk is. It's per sector, per country. So it can vary from premium rates from 0.0 something to, let's say, all the way up to 1% or even higher. So that depends really on the risk. But on average, I think you're talking about a percentage over the turnover or your outstanding balance. Average probably around the 0.2, 0.3%. So there's something around.
Would be the standard rate. You guys agree with that?
Yeah, I would guess that's kind of ballpark, you know, and I guess back to your earlier point as well, where, you know, if the cost gets too high, obviously it's a high risk. The question then becomes, you know, should we actually insure those risks? Because a premium will never cover you for a default based on the size of the risk that you cover.
So are there some sectors which carry a higher premium just because they're higher risk?
Yeah, at the end of the day, it still depends on the quality of the buyers that the policyholder is dealing with. Because in this circumstance, you know, you're dealing with a policyholder, they're buying cover on third parties that they're dealing or doing business with. So it really depends on the credit quality of those buyers. So that's what we're assessing, is what is the credit quality of those buyers. And for each policyholder, they're going to have a different maybe mix of buyers that they deal with at different levels. And all of that will sort of blend into what is the risk that we're being asked to take.
But if there was a specific company, Steve, so the famous company that went down from 100 Rand to a penny stock, if you sold to them, would you be covered?
When the policyholder comes to us, they actually apply for cover on the debtors that they have. So if they want to start trading with somebody, we will do a risk assessment of, well, what financial information have we got on that company? Do you have a trading history with that company? If you've got a trading history, what does it look like? And all of those go into the pot to say, well, are we happy with that risk? If we're not happy with that risk, then we would be telling the policyholder, actually, we don't think you should be trading with them. Or if you do, really, it should be your own risk, not ours.
So you wouldn't cover them?
Yeah. We have the right at any point in time to say, no, we don't want to cover this debtor.
But I think while they were at 100 Rand and they were covered, all transactions before the news hits the market, they are covered for those transactions. We would notify them for any future transactions that it's at risk.
So
I think it's interesting to... you've got these black swan events, completely unexpected companies that fail. And that shows that it can go very quickly. Often you see that the insurers hold cover on those companies, and then obviously if it's like an event like that, the insured will be covered. But on the other hand, you see also companies in certain industries where you can see it coming from far, far away. And that's where we see the insurers, they do that risk assessments, not only once, but continuously risk assessment on those buyers. So where they in the beginning had X exposure, they gradually reduce that exposure on those buyers. And with that, actually giving a signal to the insured, like, hey, be careful, that risk is deteriorating. Better to lower your exposures and maybe stop trading.
So that's actually one of the greatest benefits, surely, Steve, that you can tell smaller companies who wouldn't have that internal resource, where you could almost manage the credit management aspect of it.
Yeah, we are doing a part of the credit management work for the company. Again, I stress that we would expect the company to do some sort of work on it themselves. They shouldn't be going into trading with someone totally blind. But yes, we're able to help. And we were talking about that actually in the office this morning, that you have a debtor who may be trading obviously with multiple policyholders that we have. And depending on the relationship between them as a supplier and buyer and the importance of them to each other, the relationship can be very different. So we can have a policyholder with a debtor and they have an excellent payment history. But elsewhere, we could have another policyholder who's had that debtor. The relationship's not so important, and you find that the relationship slips. And we see there's late payment and so on. It's not to say at a point in time they're not paying, but they may be getting slow. Yeah. And that's a warning sign, and we're able to pass that information across and say, we're seeing this elsewhere. Even though you've got this good relationship, you're being paid on time, you need to take care. And we may ourselves say, actually, we're getting nervous, we want to reduce the cover. We're telling you this, now you need to take that into your risk factors.
So it's the important helicopter view.
Yeah.
Okay, we're off to a quick break now. Do stay with us.
"32 countries, 75 innovative risk solutions, 100 years of experience. It all adds up to being the largest general insurer in Africa. Celebrating 100 years of insurance, good and proper then, now and always.